Hey everyone, this is Matt with the Fundamental Investing Institute. Welcome to this week's Fundamentals Unfiltered. We are recording this on Tuesday, January 16th, 2026. So last week I did an overview of Warren Buffett's early career, and I was going to do this. I was going to have some reflections on his career, and I was going to do it in two parts, which probably doesn't do it justice. In fact, it doesn't do his career justice, but in the interest of abridging this, today I'm going to talk about really when he becomes the Warren Buffett, which is when he takes over Berkshire Hathaway in the 1960s and turns it into a massive investment holding company, diversified corporation with a lot of interest in common stocks. And I'm going to write a series of blog posts on my website, fundamentalinvestinginstitute.com. We're putting out, I think we already put out the first series of that. And I'm going to be writing a number of blog posts really going into more detail about Buffett's career and a lot of the lessons that I think individual investors can learn. So that said, just to give an overview, when Buffett started his partnership in the mid-1950s, and he ran what we might call a hedge fund, closed it in 1969. But in the 1960s, Buffett was taking controlling interest in positions through the fund, through the investment partnership. And one of the companies he started buying was a company called Berkshire Hathaway, which is a textile business in New England. And he started buying it because it was trading at a very low multiple of working capital. It was trading for less than working capital. So it was basically a typical cheap company, cheap based on balance sheet values. And this was the kind of investing that Buffett learned from Ben Graham when he studied with him at Columbia, and then later when he worked with him in the early 1950s. So he started buying stock in Berkshire Hathaway, and in 1964, he was set to sell that stock back to the company. Berkshire Hathaway at that time was run by a man named Seabury Stanton. And Stanton and Buffett had an agreement, a verbal agreement, on what Berkshire Hathaway would buy Buffett stock for. But when Buffett got the offer letter in the mail, got it in writing, he noticed that Stanton was undercutting him slightly on price. And this made him angry. So what does Buffett do? He goes out, he buys more stock, and eventually takes a controlling interest in the company, fires Stanton, and brings in a turnaround specialist to try to make the company profitable. Now, let me say something about the textile business. The textile business is a commodity business. And with a commodity product, the only thing that a producer can really compete on is price. So they're not good businesses. They're very low margin businesses. And in the case of the textile business, it was requiring a lot of capital that had to be brought back into the company to replace machinery and update machinery. And this is what you had to do in order to remain competitive. And of course, as foreign markets started to take over textile manufacturing in the U.S. really became a dying business. And Buffett knew that for the most part, but really tried to keep the company going. Berkshire Hathaway's textile business was actually not shut down until the mid-1980s. But in 1967, he has this turnaround specialist, and the turnaround specialist is able to get enough capital out of the business that Warren Buffett can acquire another business through Berkshire Hathaway. And this is something that he was doing when he ran his partnership, is when he had a controlling interest in a company, he could use that company to acquire other companies. So this was something he did when he was managing his partnership. It was just part of his investment strategy at the time. And what he does is he acquires an insurer called National Indemnity. The insurance business is really important for Buffett's career The reason is insurance companies produce what's called float. Now, the way insurance companies operate is they take in premiums today and they pay out money in the future for whatever contingent claims they have to settle for. But in that meantime, they can take those premiums and they can invest it. And this is what's called insurance float. In fact, most insurers do not make money on their underwriting. They make money on their investment income. So, of course, for Buffett, this was perfect because owning an insurance company gave him a very advantageous source of investment capital. But in 1967, no one really knew what his long-term intentions were. So he closes his partnership in 1969. And by his own words, the reason he closes his partnership is the 1960s, especially the late 1960s, were called the go-go years in the stock market. And during these years, it was really momentum and growth that were the predominant factors in the market. And you had a lot of so-called gunslinger mutual fund managers. The market was becoming pricey, and Buffett was still at this point very much a value investor, a deep value investor in the Graham and Dodd mold. And he really thought his strategy would likely underperform in the years ahead. So 1969, he closes the partnership. He figures he's going out ahead. And he gives his partners the option of either redeeming their shares in the partnership in cash or redeeming their shares in the partnership through a distribution of shares in Berkshire Hathaway. He didn't tell anyone what his plans were. No one knew, but he did say that he, Buffett, and his family were taking shares in Berkshire Hathaway. So when he closes, now, unfortunately, a lot of people took cash, but those who took stock in Berkshire Hathaway, of course, became very wealthy in the ensuing years. Now, as he took on the insurance companies and he started to use that money to acquire other businesses, one of the big changes of Buffett in terms of his thinking was that he starts to focus on higher quality businesses, right? These are not just the deep value investments that he made when he was running his partnership. He really starts to focus on higher quality businesses. By higher quality, what we mean is he calls them an economic moat. These are competitive advantages that a company has that would make it difficult, if not impossible, for competitors to come in and take market share. So, for example, a company like Coca-Cola, which, of course, there's been changes in tastes over the years, but at the time he acquired massive amounts of stock in Coca-Cola in the 1980s, Coca-Cola had this huge brand recognition, it still does, that made it near impossible for a competitor to come in and take meaningful market share for the company. That would not be the case in much later years, but it was the case for a long time. And Coke remains one of the best brands in the world. So that's an example of a high quality business. Now, of course, price still matters, but what Buffett was really focused on through a lot of his investment career at Berkshire Hathaway is he was focused on companies that were generating a lot of free cash flow. That is, a lot of cash flow after all the expenses were paid and all of the investments needed to maintain the company. So it was producing a lot of free cash flow, and those companies are producing high returns on invested capital. So the capital that was invested in the company to, buy buildings and maintain inventory and all those things, a great business produces very high profits for every dollar that's invested in the company. So those are the two things that Buffett really focuses on, and he wants to buy it at a certain attractive price, but he's not looking for the type of huge bargains that he was looking for before. With a lot of those bargains in kind of the Graham and Dodd mold, a lot of those companies were just bad businesses, and so you had to be very certain that you could still get a profit out of it, that the companies were not going bankrupt. But Buffett in the early 1970s, he starts to focus on much better businesses. Part of this is the influence of a man named Charlie Munger. Munger became his partner at this point, but they had been doing some deals together. He met Munger in the 50s, and they had been doing some deals together throughout the 60s. And then in the 70s, they became official partners, and Munger became vice chairman of Berkshire Hathaway. But I want to talk about a couple of things that I think are underappreciated. One is Warren Buffett at this point is no longer a money manager per se. He's really an investor. And a big part of his success had to do with the structure of Berkshire Hathaway as an investment platform. Now, at some point in the future, I'm going to do a video or possibly series of videos on the money management industry. But for now, I'll just mention that Berkshire Hathaway is a holding company. Warren Buffett did not have to worry about investors redeeming their investments. In other words, he had permanent capital. So he could behave in a way that mutual fund managers and hedge fund managers and others could not. And this gave him a huge advantage. He had a truly long-term time horizon, which most money managers do not. And this gave him a huge advantage. The other issue is that he didn't have the fees that are associated with other money managers. So if you own stock in Berkshire Hathaway, you were getting Warren Buffett's services essentially for free. Buffett made his money not so much as a manager of Berkshire Hathaway, but as a co-investor. He made his money on his shares, and that's how he became one of the wealthiest men in the world. And at various points, he was the wealthiest man in the world. And of course, he famously lives, very modestly as well. Another thing I'll say is that certainly the insurance float matters, but his whole thinking in shifting to better companies had huge advantages, and certainly had huge tax advantages, because better companies can be held for a lot of years. And if you have lower transactions, you're going to have lower taxes on those transactions. So he figured out if you buy high quality businesses, those businesses can compound over a long period of time, and you would be able to defer your tax liabilities associated with it. Those are two key things I think are big takeaways. Another I'll say is in the 1980s, when the leveraged buyout craze was going, that's when Berkshire bought a lot of smaller businesses, and they were able to buy it in their entirety. And I think that's an unappreciated point, is that Berkshire in the 1980s specifically, even into the 90s, it sort of became an alternative to for selling entrepreneurs to sell their company. It was an alternative to private equity ownership, which can have a lot of problems for entrepreneurs and in the future of those companies. So he was able to position Berkshire throughout there as a private equity alternative, and that's something that I don't think gets enough focus. But anyway, from 1964 to 2024, I think Berkshire Hathaway stock compounded at almost 20%. And that is staggering over 60 years. It would put even a $1,000 investment well into the millions. And Buffett made a lot of people a lot of money who held on to that stock. And I don't think his record will ever be replicated, but it's still important to study his career. It's still important to learn from him. And given that he just recently retired, I think that it is all the more important to remember his career, remember what he did, and try to learn from him, because not only did he act very ethically, but he was able to invest in a way that minimized a lot of errors that people would normally make. So it's important, and not just for investors, by the way, it's important for business leaders as well to really study his career. So we're going to be doing this blog post series. I'm going to go into much more detail, but that is the basic overview of when he takes over Berkshire Hathaway, starts to convert it into this holding company. And one of the things that Warren Buffett said is, unlike most conglomerates, he had a very decentralized structure, so he did not really get involved in the management of the individual companies, the dozens of companies that Berkshire owned, and he focused solely on capital allocation, which is what his real talent was. Now, for anyone who wants to know more about Warren Buffett's career, please check out our blog. We're going to be doing this blog series, and I'm going to try to go as in-depth as I possibly can. But there are a number of great books. One is The Warren Buffett Way. This is by Robert Hagstrom. He's a money manager. He provides a handful of case studies, some of Warren Buffett's better-known investments, and he breaks them down. It's a great book to learn Warren Buffett's investment process from. And there are many other books, far too many that I can provide here. But I think last week I mentioned probably the two big biographies of Warren Buffett, and that is Buffett, The Making of an American Capitalist by Roger Lowenstein, and the other is Snowball by Alice Schroeder. And those two books, for anyone who really wants to know Warren Buffett's story and career story in depth, those are the two best biographies. So with that said, next week we'll get back into doing capital markets commentary, but at the beginning of the year I really wanted to devote some time to reflecting on Buffett and his career. Again, he stepped down on January 1st, but next week we'll start getting back into more capital markets commentary. There's plenty to talk about. We're now in the second week of the year, or getting past the second week of the year, and there's plenty going on. So we'll be talking about that next week. Hope everyone has a great week, and as always, focus on the fundamentals.